Good morning and welcome everyone. Thank you for joining this webinar today as we unpack the current global market environment as well as take a look at the key focus areas for the year ahead. With the backdrop of the US election now behind us, the rising geopolitical tensions and the year-end market dynamics, there's certainly a lot to navigate as we prepare for 2025. It gives me great pleasure to welcome the Marlborough Group to present today's market updates. Marlborough has been established in 1985 and manage over £15 billion of assets and provide exceptional investment solutions for individual and intermediary and institutional investors around the world. They're an active investment management specialist, a trusted provider of authorized corporate director services, and offer a digital-first investment platform for clients. The Carrick Marlborough partnership is a strong one, and we're proud to exclusively be able to offer the Marlborough UCITS fund range to our Carrick clients. We're very fortunate to have with us today Nathan Sweeney from the Marlborough Group. Nathan is the Chief Investment Officer for the multi-asset portfolios, and as highlighted on the slide here, he has 24 years of investment management experience. And before joining Marlborough, he was the Senior Investment Manager at Architas, where he oversaw £5.7 billion of multi-asset AUM. Nathan will provide a clear-eyed analysis of current market conditions and help us sift through the noise to uncover key trends and offer some practical strategies for informed investment decision-making in the year ahead. We'll keep the presentation to 45-minute max, and the slides will be available to you after the presentation. We will be having a Q&A at the end of the presentation. Should you have any questions, please feel free to type them in the chat box at any time during the presentation, and we'll get to them at the end. So without further ado, I'll hand over to Nathan.
Okay, thank you, Rashay, for the introduction. And so today I'm going to give you a review of markets and talk about what to expect, because clearly there's been a lot happening in markets. So on the next slide, we're going to talk about performance year to date. And ultimately, we can see performance during the third quarter of this year. We can see performance for year to date this year, and we can see performance versus last year. And ultimately, just having these three pieces of performance helps to draw out some of the stories that have been happening in markets throughout the course of this year and relative to last year. So I think some of the things that stand out, clearly China stands out. Firstly, because of the poor performance that we had last year, but then the really strong performance year to date, and much of that actually coming in the third quarter. So we have seen some change in China, and that's been a change in government policy. So they're enacting more stimulus to try and get the economy going, because they've got a lot of problems in their property market, and you're starting to see the equity market pick up as a result. So that's an interesting observation. Then we also have areas which have done quite well this year, like gold, which has continued to do well. So from a perspective there have been a lot of concerns about geopolitics, a lot of concerns about inflation, a lot of concerns about government spending, and that's really helped to propel the gold price throughout the course of this year. So we've seen strong performance there. US equities are another standout with strong performance, but funnily enough, we've seen a bit of a slowdown in the pace of that growth over the third quarter, and some other areas catching up. And then government bonds, again, performance coming through in the third quarter, and that's really acknowledging those interest rate cuts that have begun across developed market central banks. So on the next slide, ultimately, what we want to talk about is some of the key things which are affecting markets. And just waiting for that slide to come up, sorry. Yeah, so sorry, on the next slide, we just have some of the key things which are happening in markets today. So the first thing I'm going to talk about is the art of the deal. So we all know that the new president of the US has been nominated. So the question is, what does that mean for markets? And so I'm going to talk about that in detail because it does have global ramifications, and we want to unpick what that means for markets generally. That also filters into the second topic, which is around the DOGE, which is the Department of Government Efficiency. So ultimately, this is a department which is being set up in the US, and we expect to see some efficiency drives coming out of that. So what does that actually mean for markets and the US as a whole? And then I do believe that there's quite a lot happening in markets today, and with Donald Trump in the presidential seat, that can lead to a lot of noise. So from our perspective, it's always trying to filter through that noise to understand what does that actually mean. So what's the signal from that noise, and what does it mean for markets? So let's start firstly with the art of the deal. So on the next slide, what I have here is I just have an image of Donald Trump's first book. So I'm not sure if anybody's read this book, but ultimately it just talks about some of the things which Donald Trump believes in. And obviously with the title of the book, The Art of the Deal, it kind of gives you a little bit of insight into the individual himself. And so one of the things which we're expecting to happen generally is the change from having politicians, career politicians in charge, to people who are more focused on business. So we're moving from this political landscape to one of deal making, and you're seeing a change in language being used by politicians, not just in the US, but also in countries like Europe and the UK and across the globe, as they all recognize the need to create growth through good, sensible business decisions. So on the next slide, what I have here is ultimately the share of US imports from various different countries. So the question really is, who does the US deal with? And if we look at some of the key countries that come up here, China has obviously been talked about a lot from a tariff perspective. And the reason behind that is because the US trades a huge amount with China. It also trades quite significantly with the EU, Mexico, and then you have Korea, Vietnam, and Taiwan. And it's interesting, if you look at the blue line, you can see that that blue line obviously peaked out in 2018. And this is when the first tariffs were initiated by the Trump presidency at that point in time. So you can see that that did impact the level of trade the US had with China. But interestingly, what you can see is a pickup on the purple bar, and that's just showing you that trade with countries like Vietnam increased. Because ultimately what happened at that period of time is when you implemented tariffs on China and ultimately made those goods more expensive to import into the US, then the providers of those goods just moved their manufacturing locations to Vietnam to circumnavigate those trade restrictions. And so what you've seen is an increase in trade from Vietnam and actually Mexico into the US as Chinese companies onshore to those locations. So it's interesting in the recent language that we've seen from the Trump presidency talking about tariffs, you're also seeing Mexico being mentioned. You're also seeing Vietnam being mentioned as well. And some of that is to do with companies trying to circumnavigate basically those tariffs. So on the next slide, it just gives you a little bit more detail on the trade balance. So ultimately, if we look at this chart here, what it's showing you is the trade balance ultimately measures if you have two countries, the US and China, are they trading equally? So if the US is buying 100 million worth of goods from China, is China buying 100 million worth of goods from the US? And the answer to that is no. So the US is running what they call a trade deficit. So they're not trading as much as the US as with China as the US is with China ultimately. So you're seeing a huge amount of Chinese goods being imported into the US, but not the similar number being exported to China. So you have this trade deficit. And this is one of the things which Donald Trump wants to focus on. So the art of the deal really comes into play here. So we know that he is a negotiator. He loves to make a deal. So for him, the art in that deal is to set up that negotiation prior to the negotiation. And a lot of that involves tactics which center around saying, we are going to do X. We're going to put 60% tariffs on all your goods. Because ultimately that forces the other party to the table to have a conversation about how can you help us? If we're buying all of your goods, what goods are you buying from us to narrow that trade deficit? So this is the thing that he's specifically targeting. And now you can see that the trade deficit with Mexico and Vietnam has gotten a lot bigger. And that's something which the Trump presidency will also look to tackle. So in terms of what does the landscape look like going forward, ultimately we expect to see tariffs coming into place on China in the beginning of next year. We expect to see negotiations with Mexico and Vietnam and the EU and Canada. And we think that the threat of tariffs will be used as a negotiation chip to broker deals, ultimately. And some of those deals, Mexico, as an example, might, I suppose, pivot towards things like immigration. Can you help us police the border better? Because we're buying lots of your goods, so what's in it for us type of arrangement. And this is what the art of the deal is all about. And it's interesting that post the election, you've had a lot of governments coming out and obviously showing their, I suppose, approval of the nomination and giving thanks and praise to Donald Trump, because this is now round two for a lot of countries, and they now know how they need to deal with Donald Trump and ultimately what they need to do to help their own vested interests, and that's getting to the negotiating table and hashing out a fair deal. And the next slide is another example of one of the areas which Donald Trump wants to focus on, and that is around spending on defense. So this chart here shows you NATO spending, and ultimately we've got spending from 2014 versus 2024. So I suppose the positive takeaway from this is that you've seen an increase in spending coming through from European countries. But from a US perspective, the expectation is that NATO members spend 2% of their GDP on defense. And as you can see, some countries are doing that and some are not. So from their perspective, as in the US perspective, they're thinking, well, look, if you're looking for military backing from the US, then you need to pay your fair share. But the art and the deal, that whole conversation leads to ultimately, yes, increase your spending, but also can you support US defense companies by buying your munitions from the US? So there's the art in getting that deal to the table as well. So the expectation is that we will see increased spending from Europe on defense, particularly if the US decides not to militarily back Ukraine. And the EU has a 300 million fund, so it's confiscated assets from Russia, which they will look to fund this. And obviously they will come up with other ways and means, but we do expect Europe to continue with that support. But it just shows you that there will be a number of different negotiations happening over the course of the next several years, targeting different areas, but it's all about ultimately driving growth for the US economy. So if we're helping your economy by buying your stuff, can you help our economy too? And that's the crux of it. Okay, so hopefully that's just given you a little bit of insight into what to expect from the Trump presidency. It'll all be about deals, and we've actually had European politicians and members of various different organizations coming out and being quite supportive of that. So Ursula von der Leyen, head of the ECB, has come out and said, we need to sit down at the negotiating table and talk about tariffs with the US. So you can see there's a very different response this time around. So from our perspective, we think that that will be more constructive because it won't lead to blanket tariffs, which could lead to inflation. So we think that there will be more deals hashed out around the globe. Okay, so on to the next segment. we're going to talk about the Department of Government Efficiency. So following the election, there was the announcement of the creation of the Department of Government Efficiency. So this is a department which is being set up to drive efficiency within the US government. It will be headed up by Elon Musk. And so the key premise here is that there is a lot of spending which is allocated to government. And the question is that spending delivering a return, or is that spending being used efficiently? So this department will look at that to see, are there examples of areas where we can improve spending? I can give you an example. So if you were to think of Elon Musk, you would probably think of Starlink. So ultimately, Elon Musk has been very successful in launching rockets into space and creating a big satellite network, and also quite recently being able to catch one of those rockets as it returns to the Earth, which just demonstrates the efficiency of the project that they have put in place. And on the other side of that, you have a government department, so NASA, which has had huge funding for decades, and they have struggled to reach the same milestones. So that's just one example of inefficiency within the government, because the private sector has proved they can do it for a lot lower cost, price, more efficiently. So I think that will be the focus, looking to see where they can improve efficiency to drive ultimately cost savings. And I think that's hugely important today, because if we look at the next slide, one of the big concerns for investors today is debt. So the level of spending by governments. So if we look at the US government as an example, the spending has been consistent. But the problem is that when you are looking to balance your budget as a government, you have money coming in the door from taxation, and then you have money going out the door through basically government spending on various different departments. So you want to have a balanced budget where the money coming in is covering what you're spending. If it's not, you're running a deficit. And what this chart highlights is that the US government has been running a consistent deficit for quite a period of time. And you can see back in the 40s that deficit blew out substantially, and that's due to the US obviously being in World War II and having to support that war and the cost of supporting that war. And you can see more recently, back in 2020, post-COVID, obviously a lot of spending coming through to support the US economy. But that spending just means that the US has a high level of debt. And so when a lot of people talk about the level of debt, on the next slide, it just highlights the cost of servicing that debt. Because if you have debt, you have to pay interest on it. And ultimately, that needs to come from somewhere. So on the left-hand side, we have federal debt. So the level of debt in the US, so the interest on that debt, and it's 3% as a percentage of GDP, which is the growth of the economy. So all the money that the economy is making in any given year, 3% of that is spent on servicing debt. That's manageable. So it's a very manageable number. But when you look at it in a different perspective, in a different light, so if we look at from a level of the actual money that the government is taking in through tax, it's nearly 20%. So they're spending a lot of the money that they're bringing in on just servicing the debt. So the key point here is that not that it's untenable at this moment in time. So, they're covering the debt, the economy is growing. So for me, it's not a concern today. However, it's not a good long-term strategy. So it is a problem in the future. So the US is looking to create this Department of Government Efficiency to ensure that the spending that they're making is actually targeting growth, creating growth, it's being used efficiently, and it's not just increasing the debt unnecessarily. So I think that this is actually quite a positive move. So we'll be watching this quite closely, because the next slide just highlights some of the repercussions of not addressing this. So what this shows you is the number of regulations which have been created in the US versus the number of laws. So generally, within any country, you have two types of employers. you've got businesses employing people, and you've got the government employing people. And if we look at the state of California, it's a really, really good example today. Because if we look at hiring in the state of California, there are more people being hired by state enterprises or government offices or state offices than there are being hired by businesses. But that doesn't really make sense, because when you think of California, you think of big tech companies and research and development and innovation. So there should be lots of business hiring. But the reason we have less business hiring today within the state of California is because you have taxes in the US which are applied at a government level. So everybody pays a certain level of tax, and then each state has its own tax on top of that. And one of the most expensive places to live in the US is California, because they have high state taxes. So if you have high state taxes, that tends to be bad for business generally. But you've got great big tech companies there, and they're okay with that. But then you have increased regulation. And the more regulation you have, it also hampers your growth as a business. So for businesses, not only do they have to withstand higher taxes, but they then have an unfriendly business environment because of regulation. To get all those regulations in place, you need more government employees. So you're hiring more people at a government level to put more structure and control in place. And then you need to increase tax to cover the cost of those individuals, because you have businesses fleeing the state because the tax and the regulatory burden is too high. So it's not a sustainable strategy. So a lot of those companies are moving to Texas, where there's less regulation at a state level and there's lower taxes. So this has been recognized by the Trump presidency. And this is why they're bringing in this Department of Government Efficiency. And this is why Donald Trump will be looking to deregulate. So try to make the business environment or business climate more friendly. So for me, I think this is something that the investment community will be looking at quite closely, because they'll be looking to see, can the US put together a blueprint which enables them to create more efficiency, to cut government spending, and to create a less regulatory environment, which is positive for businesses, which creates growth. And I think that's something which, if they can get that right, you will see lots of other countries then looking to do the same. So I come back to the initial point about, moving away from politicians to business, and you can see that trend is now beginning. So to me, this is the beginning of a new trend in politics, a new trend for governments in terms of thinking about how they spend. And if the US can get this right, then that creates a blueprint that you'll see replicated across countries. So I think it's important to focus on some of the positive initiatives and what they will mean, because I think the market today is probably still concerned about the US government and its level of debt. But I think that looking at this is more important and will be a driver of government bonds ultimately and help businesses flourish. So if we come on to the next segment, I'm just going to talk about some of the things which I think people might be concerned about. There's a great book by Nate Silver, and it's talking about deciphering the signal from the noise. I often talk about the fact that I believe we're in an environment where there is a lot more noise today. And there's a lot more noise about what could potentially go wrong, but there's less focus on actually some of the initiatives and what they mean and what could actually go right. And that's our role, is to look through that noise to find the actual signal and find the real detail on what's actually happening. And that's what I'm hoping to achieve today by relaying some of that to you. So on the next slide, inflation. So if you bring tariffs back, and if you implement tariffs en masse across various different countries, surely that's going to bring back inflation. And I think that that's something that the market today is concerned about. Personally, I think we should be less concerned about that. We've done some research and looked at research from Goldman Sachs on the expectation of what will happen and what it'll mean. So firstly, if you have tariffs, ultimately it makes the importation of goods more expensive. So that creates a one-off hit to inflation. not the sustained inflation we've had over the course of the last couple of years, which were as a result of systemic supply chain problems coming out of COVID. That was a real problem. So we're not that concerned. And then I come back to the point about the art of the deal. So a lot of the tactics are around making blanket bold statements to get people to the negotiation table to hash out a better deal. So if that's the case and that happens, you'll see the tariffs which are expected to come in don't come in at the same level and therefore don't have the same impact on inflation. And even if they do have an impact on inflation, it'll only be momentary because it's a point in time. Because what companies do if they're hit with higher costs, they change their approach. And you can see that specifically in China in some of the data I showed earlier, where those companies just change location. I'll change where we're doing business. Actually, we'll open up a plant in Mexico. It's closer than China. We're going to cut out all of that transportation cost. It's actually going to be cheaper for us to do that. So there's ways and means. But ultimately, what companies will do is if they're using a lot of products to produce whatever they're producing, they pass the cost on to all of those individual suppliers. They will pass some of that cost onto the distribution network and some of that cost onto the consumer. So the point is that not all of that cost hits the consumer. So we're not concerned about inflation. However, because we have come from a period of extremely high inflation, investors and markets will focus on this, and probably it means that they may lose out on some returns in areas like fixed income because they get that call wrong. So that's something I would caution against, is not reacting too much to the expectation of something that is unlikely to come through. On to the next slide, please. There's been a lot of talk about AI. It's been a really hot area. We have a huge amount of spending happening by big tech companies in the US as they look to change up their infrastructure. So essentially what's happening here is we have companies in the US who have lots of data. So think of any of the big companies, whether it's Apple or whether it's Facebook, they've got lots of data. So Apple's got all of your data from all of your activity on your phone. Facebook has got all of your data from all of your activity on social media. That data is stored in a data center. So it's a big room with servers with all of that information on it. They're powered by chips, microchips. NVIDIA makes microchips which can go 10 times faster. So those companies are thinking, okay, we can process this information, this data quicker to help us make more money. So let's update those chips. So you're seeing this upgrade cycle happening in the tech space. And that's why the big tech companies are spending more. So they're upgrading their hardware, upgrading their servers, upgrading the chips used in those servers so they can go faster. And with that spending, it's lowering their profits. The expectation is in the future that they will generate higher profits because their algorithms will become smarter at targeting you for advertising, selling to you the perfect product, because their algorithm will know you so well because they have the data. And so that's the benefit for these companies. And those companies are likely to succeed in that, but in the short term, they are probably likely to disappoint on some of their earnings. And you can see this in the share price of the big tech companies over the course of the last couple of months. So they've been trading sideways as a basket of companies for the last couple of months. So our view is that you see a bit of a broadening out. So a participation from other areas of the market. So the next slide highlights this because what you should see happen is if you have, think of those big companies are global, so they distribute internationally. So they're more at risk from tariffs and the impact that that has on consumers and relationships with the international community. Whereas if you're a domestically focused company in the US, you're going to benefit from deregulation. You're going to benefit from tax cuts. You're going to benefit from companies reshoring, moving that manufacturing from somewhere where there's now tariffs back onshore. So bringing those jobs back home. And ultimately, that means that the environment looks better for companies down the cap scale outside of those big international distributors. Plus, on top of that, you have interest rate cuts, which is a great catalyst for smaller companies. So our belief is that we get this broader participation And it's actually beginning to happen. And if you look at the performance of the big versus the rest of the rest of the market has been doing better since Donald Trump was elected. So for us, that's one of the themes which we expect to gain traction throughout 2025. But I do expect there to be lots of noise. So remember that there will be lots of noise coming through social media, whether that's Twitter or different platforms on this is being said. But you have to remember that this is being said to provocate, to necessitate a deal. So it's seeing through that as actually that's just for this. So putting tariffs on Mexico, or actually is this about sorting out immigration? So I do think, from our perspective, it's just about looking for that signal from the noise. So therefore, I think that the initiatives which are being put in place are actually a bigger beneficiary to growth, the economy and companies, and will overcome all of the noise in markets. And I expect next year again to be a good year. So I'm going to pause there just to see if there's any questions on any of the market update.
Thank you, Danny. Nathan, sorry. There's a few questions that have come through, which I'd like to pose. So I think the first one is around the dollar and this dollar strength that we're seeing in recent weeks, which is somewhat contradictory to a declining interest rate environment. So would you be able to just touch on that for a bit?
Yeah, so generally if you have interest rates coming down, it means that there's more dollars in circulation and it weakens your currency. So if you have less of your currency, it strengthens it. And the expectation was with interest rates coming down, we would have a weaker dollar. And that was playing out through the third quarter of this year. And suddenly that's changed. And that's changed because Donald Trump has been elected, and the initiatives which he's been talking about and looking to put in place are pro-economic growth. And if you have a strong economy, it means that you don't necessarily have to reduce interest rates as quickly as everybody thought they would. And that's why we're seeing that dollar strength. So I think that much of that is already played out. And now what the market wants to see is that strength actually coming through? So are the initiatives which they expect to happen going to happen? So I think you see a little bit of a weakening coming back as some of that comes through. And generally now the market will be expecting higher growth, etc. So I think a lot of that's played out already.
Okay, fantastic. Thanks, Nathan. And then we have a question specifically on emerging markets, obviously relevant to us here in South Africa. What is your view on emerging markets? Is there a bit more of a risk on appetite, and is emerging markets, ultimately starting to look attractive again?
Yeah, so I think in simple answers, yes. I think the one hurdle to that has obviously been the impact of potential tariffs. So once the word tariff is mentioned, it's not really good for emerging markets. But if you think about emerging markets, one of the biggest countries is China in emerging markets. And ultimately, China is looking to address the problems they have in the property market. So I think they've drawn a line under the sand in terms of that market falling. And you're seeing increased stimulus coming through. And what the Chinese government is likely to do from here is to wait to see what the implication is of those negotiations around tariffs. And once we're through that, you're likely to see more stimulus coming through. So I think we need to get through the first quarter of next year, because that's when you're likely to see the negotiations with China happening as soon as Trump is in office. The first thing he's going to do. And then following that, I think it creates an opportunity, because from a valuation perspective, valuations are quite cheap. You've already seen the strengthening of the dollar, and you need to see continued growth coming through, but we don't expect that. So we think actually emerging markets are beginning to look really attractive at this moment in time.
Okay, fantastic. Thanks, Nathan. We then have a question on gold prices, and obviously you started the presentation highlighting, the strength of gold in recent times. Is this something you see continuing? And if so, why would you speculate to that?
Yeah, okay. So I think, gold has been really, really strong this year. So you're talking about a plus 30% return, which is, a unusual performance from gold. And there's probably several reasons for that. So firstly, concerns about inflation, concerns about government debt, concerns about geopolitics. And if we look at some of those issues, they're starting to fade. So with geopolitics, we have a ceasefire with Lebanon just being announced. You also have, I suppose, from an inflationary perspective, inflation is coming down, but there'll be question marks around what tariffs mean for that. So some of the reasons why people have been allocating to gold are subsiding. And we've also recently had the US government talking about the allocation to cryptocurrency as a reserve. So again, that changes the dynamic as well for gold. And I've talked a lot about the Department of Government Efficiency because it's ultimately people concerned about spending, government spending, and is that diluting cash generally? And therefore, I want to hold some gold as a hedge. So if the Department of Government Efficiency can actually come up with some really good initiatives to rein in spending, then I think that takes away another tailwind for gold. So I don't expect gold to repeat the performance it's had this year, next year. And I think that there's better opportunities elsewhere.
Okay, fantastic. I am conscious of time, and we'll leave the questions there for now. And if there are any other questions that have come through, we're more than happy to address those post the webinar, and we'll get back to you. If there's anything that does come to mind later or post the webinar, please feel free to reach out directly to your wealth manager or to our wealth management inbox directly, and we'll certainly address those questions.
Okay, so now I'm going to talk a little bit about positioning within the portfolios. So what are our headline views? What are we thinking about markets? So I think firstly, what we try to do is we sit down and we come up with a scenario analysis. So we ascribe a probability to what we expect to happen. And we come up with our central case. And then we come up with what if we're wrong and things are better, or what if we're wrong and things are worse. So we have that likelihood here, and you can see the probabilities. So our central case is that there's likely to be a moderate slowdown in growth. And you're seeing that across areas like Europe, the UK, China. The US has been an exception, but even still recently the growth continues to moderate. Inflation falling to target, and again, we're seeing that happening pretty much across the globe. Inflation is within a whisker of that target for a lot of countries, and it's bobbling around that 2 to 3% area. So again, not a meaningful concern at the moment. And that means that we get this gradual reduction in interest rates, which again, we've seen. So we're seeing a lot of the key developed market central banks reducing rates. And we would say that that's really good for equities because the cost of financing is coming down and inflation is less of a headwind for costs for companies, particularly the cost of stuff that they use as inputs in their businesses. It's good for bonds too, because bonds benefit as interest rates fall. But there could be a possibility that things are better than expected. I would say there's probably only one region where we expect that to happen, and that's the US. A lot of people have talked about exceptionalism, so the US economy being stronger than expected. So in that case, GDP or growth remains steady, inflation remains above target, and interest rates are higher for longer. But even within that, we can see in the US inflation, even though the economy is strong, inflation is coming down and interest rates are starting to move. So we're kind of in between the two. And actually, it's been really good for the equity market, less so for the bond market as interest rates haven't come through as quickly as expected. And then finally, we have what happens if things are worse than expected. And the probability of this continues to diminish with some of the initiatives we expect to come into play next year. So lower inflation, plus tax cuts, plus deregulation. So it's unlikely that we get a material slowdown in growth or inflation turning negative and a much quicker reduction in interest rates. But if you were to see a recession, that's exactly what would happen. It would be bad for equities, but for a short period of time, because once those interest rate cuts come through, which they would, central banks would react to a big slowdown in the economy. You'd expect to see equities actually doing quite well. So on the next slide, what we have is just a little bit of a continuation of the view. And it just shows you our tactical asset allocation positioning. So how do we view equities? How do we view bonds? How do we view cash? We think equities are a good place to be. And they are being supported by falling interest rates, and deregulation will help again next year because it means company earnings can get a boost from that. We are overweight government bonds because when you cut interest rates, they perform. We're underweight cash. So we would say cash is trash at this moment of the cycle, because ultimately, if you are overweight cash today and interest rates are falling, you're missing out on the opportunities and the benefits from investing in bonds and equities, which benefit more from the effect of interest rates falling. And that's why we're underweight cash today. But what we do is we sit down every single month, we go through every single asset class, we write out detailed views of how we view them, and we use various different research inputs like Absolute Strategy research, Goldman Sachs research to help formulate those views. So one area we do like is actually UK equities. So why would you like UK equities? Well, firstly, growth is okay, but interest rates are coming down and that's supportive. Valuations are quite cheap. Because the UK is quite cheap at the moment, you're getting a lot of international buyers coming into the market, so there's lots of M&A. And then from a Trump perspective, as in the new government coming through, there's less risk of tariffs because the UK doesn't run a trade deficit with the US, so it's not in the firing line. And therefore, you're seeing allocators looking to UK over areas like Europe, where there is an expectation that there'll be tariffs on autos, which are then being sold into the US. So in the same manner, we like UK government bonds over global, which are predominantly US, because we think the market is still concerned about US spending. Even though I've talked a lot about the initiatives, which are expected to reduce growth until the market sees those happening and the implications of those and gets, obviously some confirmation that that's happening, they're going to prefer not to take that risk. So ultimately, we like UK bonds. And then infrastructure is an area we like too. And infrastructure ultimately just means investing in long-term projects like building a road or an airport or a rail network. They take multiple years or decades. So the funding of that project is extremely important. So if interest rates are high, it's going to cost you a lot of money to get that project to completion. If interest rates are coming down, it frees up a lot of headway from a cost perspective. So infrastructure as an asset class has been doing well this year as interest rates have been coming down. So I suppose in summary, our view is that we will have a moderate slowdown over the course of the next year, and that leads to a path of lower inflation, and that leads to interest rate cuts, which are supportive. And I think coupled with that, we have continued deregulation that will be beneficial for equities and their earnings as we move into 2025. So happy to take any questions on any of that.
Thank you, Nathan, for what is definitely an informative market update and sharing some really good insights into next year. That's where we're going to close it today. Thank you all for attending today's webinar. We really do appreciate your attendance. Apologies if we didn't get to any further questions that you had, but we will revert back to you on those questions in the coming days. If there's anything else that does come to mind, please feel free to email or get in touch with your private wealth manager directly, or use the email on the screen to get in touch with us, and we more than gladly take those questions. Thank you very much again, and I'm wishing you all a lovely weekend. Cheers. Bye-bye.